So, CoreWeave. They're right in the engine room of this whole AI boom, aren't they? Specializing in that high-density GPU cloud rental. But here's the thing. You might have, $55 billion in future demand locked up? But if you can't actually plug the servers in on time, well, the market doesn't wait. And that massive conflict, the huge future potential versus these immediate execution failures, that's exactly why the stock is getting absolutely hammered this morning. Welcome to De-Risk, a podcast where we provide a no-nonsense analysis of stocks.
Exactly. And our mission today, really digging into our research, which we captured this morning, November 11th, 2025, is to figure this out. Is this just a temporary glitch, like a construction delay for what could be a skyscraper of a company? Or, is there something more fundamentally flawed here?
Yeah, and the broader market isn't exactly helping them out today, is it?
Not at all. The mood is cautious. You see the NASDAQ Q100 pointing lower. Everyone's waiting on NFIB data, a Fed speech later.
Yeah.
CoreWeave definitely doesn't have a market tailwind right now.
Okay, let's start with the good news, though, because there was good news. That Q3 revenue beat, $1.36 billion. That's solid.
What's more than solid?
Yeah.
That proves the demand is absolutely white hot. And then you look at the anchor, the real long-term story. Their backlog, that remaining performance obligation, the RPO, think of it like guaranteed future cash. That number swelled to, a jaw-dropping $55.6 billion.
$55.6 billion. Wow.
Yeah, up from around $30 billion last quarter. These are multi-year deals locked in with giants. Think Meta, OpenAI. I mean, this should make the stock feel almost bulletproof. They're right at the epicenter of AI.
It really should. And historically, hasn't the market sometimes looked past these kinds of short-term execution hiccups when the long-term picture looks that good? What exactly is spooking everyone right now?
It's laser focus on one thing: execution. The stock sold off hard, not because demand vanished, obviously not with that RPO. It's because they hit a delay in getting new data center capacity online, and that forced them to cut their full year 2025 revenue guidance.
The guidance cut. That always hurts.
It does. And the delay itself, it sounds like it's down to specific things, supply chain issues for, like advanced cooling parts, specialized GPUs, the kind of real-world headaches you get when you're trying to build the absolute fastest cloud infrastructure out there.
So the long-term vision is intact, the demand is there, but the actual building of it is hitting snags. And Wall Street's split on how to weigh that.
Completely fractured. You've got about 52% still saying buy or strong buy, arguing that huge RPO is what ultimately matters. But then you have a pretty big chunk, 37%, shifting to hold. Even the quant models are throwing up their hands, basically calling fair value undetermined right now.
That uncertainty really shows up in the market positioning too, doesn't it? Let's talk about the bears first.
Yeah, they're definitely making noise. Short interest is sitting at 12.28% of the float. Pretty significant.
Over a tenth of the shares are betting these operational problems are going to drag the stock down further in the near term.
But then you look at the options market, the quote-unquote fast money. There's a different story. The put-call ratio is actually low, down at 0.79.
Meaning more calls being bought than puts.
Exactly. Suggesting traders, or at least some segment of them, see this big sell-off as maybe an overreaction. They're positioning for a bounce.
Fascinating split. But the price chart, well, that's the immediate brutal verdict, isn't it?
It really is.
The stock just fell off a cliff. $110.30 yesterday close, down to $97.62 pre-market. That's the market putting a price tag on those delays.
And technically speaking, that chart looks genuinely broken right now. The volume tells a tale too. Huge volume. 42 million shares yesterday, another 52 million after hours. That screams institutional selling. The big players are heading for the exits, or at least reducing exposure.
And it's sliced right through key levels.
Oh yeah, blew straight through the 50-day moving average, which was way up at 122 tolls. Gone. The only tiny glimmer of hope on the chart is that momentum is getting close to oversold territory, which might suggest the drop is overdone in the very short term, maybe.
Okay, so pulling all this together, this massive $55 billion future clashing with a guidance cut and a technically broken chart right now. What's the bottom line strategic view from our research?
Look, based on the data, we have to lean towards a neutral stance, but definitely with a bearish bias for the near term. The guidance cut, combined with that severe technical damage, it just overshadows that incredible long-term RPO figure right now. The market's focused on the present pain.
So what are the key levels traders should be watching?
Okay, immediate support is right around $96.75. If it breaks below that convincingly, the door really opens towards the $90 level. On the upside, it needs to get back above the psychological $100 mark first, but the real test, the level it absolutely must reclaim to even begin to invalidate this bearish picture, is yesterday's close around $105.61.
So CoreWeave clearly has a destination way up in the stratosphere, powered by that undeniable AI demand. But right now, the market seems totally fixated on the mechanical problems back here at Mission Control. The big question for you is, what will you bet on? The long-term journey or the short-term turbulence? That's all for this deep dive. Remember, this podcast is for informational purposes only and isn't financial advice. Do your own research or consult with qualified financial advisors before making any investments. Thanks for tuning in. Catch you in the next episode.